Hello and welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for joining us. We really appreciate it. Don't forget to subscribe or comment down below. Now this is part 3 of a 6-part series. We're going to be going through United Airlines. I would suggest you go back to part 1 and watch these in order to get the context. And then part 6 will be the summary, which I definitely think you should watch, and have these 5 other videos as context and background. All right, let's dive right into United. So United started the decade with $37.1 billion of revenue, and they have been able to grow that to $43 billion of revenue over the last 9 or 10 years. That's an average of 2%, which is essentially inflation. So I'd put this as flat in real terms. They've got a little inflation to keep pricing power, but the company itself doesn't seem to be accelerating into the market. Operating income and depreciation gives us EBITDA. Let's take a look at EBITDA. Started at $3.2 billion and they've grown this to $6.5 billion, which is a good sign. Okay, if you've got flat revenue, if revenue is hard to grow, you're expanding. Your growth comes from expanding earnings, which is growing margin, and that's nice to see. That's a 15% annual growth rate, which is very respectable on flat revenue. Let's look for an EBITDA and debt levels to smell check those two. So we're picking up with the debt on the balance sheet, that is current portion of long-term debt, any lease obligations that they have, and any obviously pension liabilities. And they started at 17 and they've grown that to 22.6. Market cap is share price times shares outstanding. I add these two up and I get an enterprise value. Once again, just to check, enterprise value is how you value the company as a whole, and it's the way we look at it. If you're going to buy the airline, you want to be in it for the whole company, not just because the price moves around. All right, so enterprise value going from 23 to $45 billion. Here's the market multiples. So this is the valuation that the market has given United Airlines over the last decade. It's at a low of 5.3, at a high of 13.1, averaging 8.2. Again, seems to be pretty in line with the other, on the average, other stocks that we've seen. Here's the key one right now, given the turmoil or turbulence, as one viewer put it, on the airline stocks, is the debt level. You can see the debt level for United has been at a high of 9.3, which is extremely levered, and then a low of, call it, 2.2. It looks like they've grown it recently from 2.2 up to 3.4. That's a concern, so I would put them as slightly ahead of where we like to see as a maximum of 3 debt. This airline is levered above our limit. Let's go look at cash flow and see how that stacks up. So here's the free cash flow from operations, starting $2.4 billion to $7 billion of free cash flow from operations. That's a good sign. It lines up with the EBITDA. So even though revenue's flatlined, they've been able to grow margins, and that margin growth has translated into cash flow, which you're seeing here. Cash flow from operations, less CapEx. CapEx would be buying of airplanes, investing in infrastructure. You can see that each year the CapEx is greater, the free cash flow from operations is greater than the CapEx, means they can afford their planes in cash. They choose to use debt, which is a good sign. Debt payments, largely negative. It looks like they've kind of paid down debt and recently may have been issuing, which is what we saw when we looked at the balance sheet. Shares outstanding. Now they've reduced their balance sheet, they've reduced the shares outstanding quite substantially over the decade, buying down 21% of all outstanding shares. This means that if you owned a share back in the day, it now has 20% more ownership stake in the company, which is a good thing. But given that they've taken on more debt at the same time, I think it would have been a safer play to take that cash flow and buy down debt, rather than rewarding the shareholders by buying back stock. That, I think, is going to give them a problem in this current economic climate. But let's keep going and finish the cash flow analysis. So the free cash flow to equity is positive and growing, which is a good thing to see. This growth recently is probably based on less debt payment. I would have liked to see a little less free cash flow here. As far as a yield, it looks like the stock price itself is trading fairly richly, which is what we've seen in the EBITDA multiple. So the yield isn't all that high, and growth rate is negative, largely because of this change. I don't think that growth rate properly reflects what we're seeing in the trends, but it's the math exercise. All right, so now let's forecast forward what we think the 2029 stock price would be for United Airlines. We'll do it on the cash flow basis first. Again, following the same exact forecast throughout this series to give a level playing field to all the stocks. I'm giving zero free cash flow for 3 years. Whatever debt they're going to have to take on to get through this crisis, they're going to have to pay that down. That means no distributable cash flow to the equity holders. Then I'm picking up free cash flow of $7.02. That's the average of the last 3 years. And I'm stringing that forward at a very small growth rate of sub 5%. And I get $108 stock valuation. Let's look at EBITDA. EBITDA, $5.8 billion. That's the average of the last 3 years. Again, I don't think this is going to happen because of Corona. But long term, if they were able to survive, they should be able to recover and get back to that growth metric that they were experiencing. That puts an enterprise value of $70 billion, less a good healthy doses of debt, and some shares outstanding gives me a stock estimate of $127 a share. Again, I've taken the current outstanding shares and I've grown it by 10% because they're going to have to dilute themselves to some degree to be able to survive this crisis, and we'll cover that in the summary video. Let's then look at a current stock price. Current stock price for United is $25.56. We're using our forecast valuation of $154. That's the average of the free cash flow method and the market multiple method. If I string that into an IRR, you'll see we're investing $25. You get zero cash flow as the company has to rebuild itself. And then you start getting a little cash flow out in the future, eventually selling it at our price target. And the compound return for that is 31% over time. And that's an 8 times your money cash on cash if you held it for a decade. So very strong returns if it survives. The question is, will it? So tune in to the next video. We're going to look at another airline and then watch the summary to see how the airlines compete against each other for your money. My name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing. See you next time.